G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and each episode we bring in someone who maybe I personally know, or maybe someone who's a top thought leader in the industry of property investing. And today's guest, I have to say, I am pumped to bring on Ross Lacane. Welcome to the show, mate.
Oh, it's great to be here. Thanks for having me, Aaron.
Mate, it's been a long time, and I say that because we've known each other for a long time. We go back quite a while. I won't indulge how many years, but mate, I've seen your journey. I've seen your journey as a mortgage broker. I've seen you build an incredible business. So for those who aren't aware of Ross Lacane ran Aussie Parramatta, which was the most successful Aussie business in the country. I'm going to say for about 5 years running, and then on top of that, took out numerous industry accolades, which is no easy feat. We're talking at the Australian Broking Awards. We're talking Brokerage of the Year, back-to-back winners. And then off the back of that, Ross took his business to $1 billion. So if you can understand that in lending terms, $1 billion in lending, which very few brokers, we're talking a handful of brokers, go on to achieve. So the respect that I have for Ross is second to none. Ross gives up his time to help a number of brokers. And off the back of that ethos, helping and guiding, Ross has now gone to start $1 Billion Broker, which is a coaching and mentoring program for a lot of mortgage brokers who maybe want to get to the $1 billion loan book, or maybe who want to scale and grow their business, which kind of has a lot of similarities when we're talking about scaling and growing your property portfolio as well, Ross.
Exactly right. I quite often use the analogy of growing a loan book to growing a property portfolio.
Yep.
You've got your three stages. You've got your accumulation, where you're accumulating properties.
Yep.
You've got your consolidation, where you're paying them down or getting to a point where they're funding themselves. And then you've got the retirement income from the properties, right? And growing a mortgage broking loan book is very similar, right? You may earn less profits and grow your book because you're investing back in to get the accumulation. You may consolidate, by consolidating your staff or your team. And then the beauty about mortgage broking is it gives you that loan book, which gives you options in retirement, right? So there's very much parallels around investing and obviously running a mortgage broking business.
Spot on. And one of the parallels then goes to almost the Pareto principle, right? 80-20. So you talk about 20% of investors will then go on to be top tier, maybe investors, for example. Same with the broking industry, probably the top 20% are making 80% of income, right? And you've probably seen that firsthand. It's a tough industry, a bit like investing in property, where it's a lot start out and then some stumble along the way and maybe make a decision that sets them backwards, for example, maybe a bit like a hiring or a growth decision that sets you back. And that's kind of one of the topics I want to have a chat to you about, which is, as you grew your business, your ideal client was a property investor, and you breathed it as well. So I do want to kind of just start this episode by saying, this is a general discussion, and it's not intended to give advice. So if you are seeking advice, please speak to one of your special professionals in your team as well. But Ross, before we do kick off, it's what I call the 3 Ps. So a bit about yourself personally, a bit about yourself professionally, and a bit about yourself on your property journey as well. Okay,
beautiful. We'll start personally. I've just got back from Jindabyne, where I just competed in the Snowy Classic. So it was a 170K road cycling race where I did with a bunch of guys, where we've been training for a number of months now. So it was a real achievement for me. I felt proud to obviously, to finish it. I went through the Hurt Locker, I'm not going to say, climb up Perisher. I wanted to stop. I saw the sign that said 5Ks and I had 20Ks to go, and I was in a lot of pain, but kind of like business and property investing, you just got to keep pedaling, right? So that's a bit about personally. So next was professionally,
yeah. So your transition now, your career, which is, I think it's a testament to what you've built and being able to then have your next iteration.
Professionally, the reason that I started the $1 Billion Broker was about giving back. When I was as a mortgage broker, as I was growing my business, I had to look overseas for mentors, people that had been there and done that,
Yep.
To help me sort of get to the next levels and to get new ideas within my business. So in terms of growing a successful business, earning the income, growing a successful property portfolio, you realize there's more to success than money, right?
Yeah.
Yes, it's great. It gives you the sort of certain level of freedom, but it's not going to necessarily make you happy. What I found, would give me that joy and happiness is to give back to others and really serve, and hence the $1 billion broker business was born.
Wonderful. I mean, that truly comes from a place of abundance, right? And it's not a throwaway word. It's definitely a word that I feel like rings true to yourself and other industry stalwarts as well, which is I've fed myself and I've grown my business, and now the role now is to pass the baton on and see the next generation grow, succeed, develop. And that we see that consistently with a lot of buyers agents as well who've built their own portfolio. They're not necessarily now looking to add more to it. They're going, well, now my job is to lift up others and give them the confidence and pass that baton on as well.
Yeah, exactly right. And it's hard, right? A lot of us get in that selfish sort of point where we get to that point, and it takes courage to step away from doing what you're doing that has always worked.
You step away from the herd.
Kind of like the leap in, buying your first property. You've got to get outside that comfort zone, right? You see a lot of property investors have that analysis paralysis where they've done so much analysis. They've been to all the seminars, they've read all the books, yet they're yet to take that step out the comfort zone to buy their first property, right? And sort of in business, it's the same. As we're sort of growing a business, there's junctures in your career where you're going to have to make that decision to do something that to go from a place that's working to something that you may not know will actually work out. But it's that leap of faith to be able to sort of take that step and to be able to do that.
Wonderful. When you talked about clients getting stuck in analysis paralysis, and I mentioned earlier that you had that sweet spot because you worked predominantly with property investors, take me through, I mean, it's obviously too close for me. It's too close to home for me to talk about broking because this is what I do on a daily basis. But now you've been able to step out and you look at your client interactions and the ones that you can see it, the ones that you helped to take action, the ones that you saw kind of DIY'd and maybe stumbled, maybe some got lucky, and some others that just said, hey, look, I'm going to leave this to a professional, and now look where they've ended up. Take me through, if you kind of can cast your mind back to your broking days and go, how did that broker relationship client work kind of when you look backwards?
Yeah, I mean, you make a great point, right? In terms of there's the people that like to DIY, as you said. There's the people that like to engage a team of professionals around them, and there's the people that do their own research and don't do anything, right? Yeah. So if you look at it, the people who I found were the most successful were the people who surrounded them with a great team, right? So whether that be a good broker like yourself, Aaron, is really central to that point. And, from there, I'm sure you've got recommendations into good buyers agents, good property managers, good solicitors, etc., right, to help people on the journey. And the thing I've found why that is most successful is because there's an opportunity cost, right? There's an opportunity cost in terms of how quickly people can act and get in the market. And let's face it, I know my life and I'm sure your life, Aaron, with kids, with running a business, with everything that goes a lot. One thing that most of us have in common is we don't have a lot of time, right? And when it's your own home, there's motivation to get into that dream home and to scour realestate.com and, really get a good understanding of the market. So you can find that. There's not that same motivation when it comes to investing in property, right? Yes, it's great and it'll provide wealth down the track, but there's not that same emotional drive to do it.
Correct.
So the people that surround themselves with a team, and I was in the industry myself, and I had access to all the same tools that you've got, RP data, realestate.com. I understood mortgages, but
we got every property report there was.
Yeah, exactly. But I still chose to use a team because the one thing that I didn't have was time. And if you look at the growth that we've had in the market is a perfect example. Some areas have had 20% plus growth, some a lot more than that, right? But if you look at that opportunity cost for that investor, had they got in, 12 months ago, that $1 million property is now worth an extra 200,000. Where the time that it takes for someone to research, understand, try to keep up with the market, they've just cost themselves $200,000 worth of growth.
Yeah,
because they haven't engaged a team of professionals. They've tried to do it themselves to save some money.
Yeah,
where they've ended up sort of costing them money. So, in terms of when you look at that option, I think the people that engaged professionals got the right advice, just like you would if you were buying, $500,000, paying $500,000 for a business. You'd get advice, right? You get mentoring, you get training. I think too many of us, because it's property, because we've lived in a property most of our lives, we understand what they do and how they work. We think we're in the best position to treat our property investing like a business. And I think that's where the DIYers fall short from people who are taking it seriously and are prepared to pay for professional advice.
Yeah, that last point, we said people are willing to pay for advice. It's what I call skin in the game. So when you pay for something, it's a bit like there's got to be a stat, and I'll dig it up, where people have those free online courses and what's the completion rate versus people that pay for an online course, for example, probably have a much higher completion rate. The same would ring true for people that pay, say, a buyer's agent, 10, 15 grand. Now there's a pay to play mentality, and I want to get a return on that investment versus the DIY. It's like you maybe don't value your time in the same vein as paying someone as well.
Oh, exactly right. If I look at my own portfolio, I think most of them I've used the buyer's agent. I think those properties have performed better than the one that I purchased myself. But as I say, that cost over time is negligible.
Perfect. You just touched on something that I wanted to ask you about, which is your own portfolio. And I don't often ask people, guests, you're obviously a guest in our house. I don't ask you to divulge personal sensitive data, but just take us on your journey and say, look, whatever you're comfortable to share about your own journey, your own acquisitions and what you bought and why potentially. I think that'd be super helpful because I know you lived and breathed this yourself as well, right? Yeah,
beautiful. So in terms of if we look at in terms of when I started investing, and I started investing back in 2011. So just a bit over
10
years ago, and I bought my first property. It was a property in Cranebrook. I remember being at the property investment seminar with a buyer's agent at the time, and they flashed this property up on screen. I'm like, oh, that looks all right. So it was a property. It was 262,000. I think it was renting out for about, I don't know, maybe 320 or something for that at the time. So it was fairly neutral from a cash flow perspective. It was brick and tile. You could barely build something for that sort of price.
Right.
So I thought it was a no-brainer, right? A no-brainer to sort of pick that one up. And I look at the value of that property today. It's probably, just over 10 years. It's probably valued about, I've got it on my portfolio, about $805,000.
Fantastic.
Right? So, and again, would it be a property that I would have lived in? No, I actually visited there, and the neighbours scared me a little bit, right? So it's not something I would have lived in myself, but it was a great sort of first purchase. And at that point in time, the Sydney market was, sort of ready to go, right? It was ready to go. I think we had our boom in sort of 2003, 2004, and this was sort of at the I felt it was at the start of the next sort of phase for Sydney.
So that phase, take me through this just because I'm curious, because you've got kind of a declining market. We see it on the property clock, for example, which is great. You've got kind of peak of the market, then it starts to drop a little bit. And no one really truly knows when the bottom is, because we've already kind of bounced up a little bit. So it's almost like, how do you catch it maybe on the way up, or how do you catch it on that way down? So take me through that. Where do you
and again, you want to catch it on the way up, right?
Yeah, okay.
Why do you want to catch it on the way up?
Great. I mean, the equity is now going to start to lift.
Exactly. It's going to start to lift, and I'm going to be able to recycle my equity, get that out, and get it into the next property, which is how most of the property investors that I worked with as a broker do it, right? Yeah. And again, the reason I don't like brand new properties and off the plan, because much like a brand new vehicle, those properties quite often go down in value before they go up.
Yeah, that's
right?
a fair point.
So
that's a fair point.
You're not going to get your equity out of those properties as quickly. And I've had some clients that have built portfolios of up to 80 properties, right? And it's no different. They just work by leapfrogging off the next property to get the deposit and the equity to buy the second property. And then go to 2 to 4, they do the same thing. To go from 4 to 8, they do the same thing, right? So you're piggybacking off the property. So if that property is on the downswing, or it's going to have, you're buying it at the bottom of the market and you don't know when that market's going to rise, you may be waiting a while. And again, that opportunity cost comes into it before you can get into the market down the track. Yeah,
nice. That's what I call that, the frustrated investor. They've got the means and they've got the ability, but the property hasn't had the growth. So they're just kind of stuck trying to revalue it, trying to get some equity out. And it's like, what are we squeezing? Blood from a stone, perhaps?
Yeah, exactly. Yeah. You're looking at markets like WA at the moment, where it's been flat for basically the last 10 years, and now they're just starting to see some strong growth. Right, those people haven't had the ability. So even though people have been talking about the potential of Perth for the last couple of years, if you invested there 3 or 4 years ago when people started talking about it, it's only now that you would have a chance to access your equity back.
Now, and it's a bit like what Brisbane was maybe 3 years ago. There was a lot of buyers agents buying in Brisbane. It hadn't taken off yet. But you look now, and it's like Brisbane is becoming the darling of Australian property market. Yeah. It's just doing some incredible numbers, kind of where Sydney and Melbourne have handed across to Brizzy.
Yeah. So then my next property was about a year later, and this was, I reckon, the best buy that I ever bought. Was a 5-bedroom property in a suburb of Campbelltown called Roos. Again, the buyer's agent found it. It was just one of those no-brainers, right? I did a $40,000 renovation on it. I remember, this was one where we actually did some work ourselves, and we ripped up the carpet and got the dust mite bites to prove it, and did a cheap renovation, but got people in and rented it out for about $460 a week at the time. Again, that sort of paid for itself. But that property is nearly tripled in value in 10 years. Unreal. Right? So the value on that property is probably about 910 today. So, amazing sort of thing. And if you think about it, there's no way people can save that sort of money, right? If you look at that, how can you save $600,000 in 10 years' time?
And I read a stat that most people on this current property upswing have made more than top tier surgeons and CEOs on the uplift in their properties, right? Like, you cannot physically earn that much in the last couple of years in the bull run that we've had.
And even if you earn that much, you can't save that much, right?
Correct.
Property as a vehicle for wealth, if you're in it for the long term, there's nothing like it, right? From a leverage perspective, and when you look at the returns compounding over time, nothing sort of beats it. So then I bought a couple more properties in Sydney, because I could just see the market had that momentum, right? And I've been a mortgage broker for a long time. I've been a mortgage broker for since the last sort of boom, which was sort of February 2003. I started as a mortgage broker. And so I knew that the markets had that sort of momentum in them, right? So the next purchase, even though I wasn't getting them under market value, even at market value, I knew to get in then and there, I was going to get some good growth out of those properties, which I did. And so once I saw that market coming to an end, that's when I decided, I'm going to look at the next sort of place to invest. And then, I bought a couple of properties in Brisbane. I bought one in Melbourne, and then a couple more in Queensland, and then another one in Victoria. And then, sort of balance that out with one in South Australia in Glenelg. And just recently I've got back into the market, and now I'm in WA as well. So because I saw the market was flat in WA and I wanted to balance my portfolio, I thought, let's get a couple. So there's two side by side in WA, and I'm looking to sort of pick up the third one in a row next. And you talk about the strategy behind that. That's got good cash flow now, so I can hold it. But what I'm looking for now in my portfolio is slightly different to what I was doing in the sort of the accumulation phase. I want properties with an X factor. I want properties with an X factor that, down the track, I can potentially do something with these properties. Yeah. So really that's the stage in my portfolio that I'm looking at now. I'll probably get better quality assets in the portfolio and look to, again, get a little bit more focused on capital growth rather than the cash flow. And in the early days, I was very much focused on cash flow because my view was if I can hold X number of properties for the same outlay that I saw some of my clients and some of property investors buy one property for, then I was crazy not to hold a bigger range, right? For the same out of cash, out of pocket investment, I would rather have further leverage. And back in those days when I was investing, lending was a lot easier than what it is today. That's for sure.
And I feel like that's become that turning point for quality versus quantity. I feel like all the changes that happen, all the interest only sweeping changes that came through, the way the banks look at investors now, it has favored buying quality, whereas previously a lot of people were able to buy and accumulate quantity of properties, right? Like, you look at the way serviceability works now, you don't have to be a genius to figure out you will hit a wall at some point with your borrowing capacity, isn't it?
Yeah, definitely right. Definitely right. Once you sort of get to a certain level, yes, there are ways. There are ways that you can sort of definitely look at, especially for self-employed people. I know through business banking avenues and so forth has allowed me to sort of look outside the square a little bit and look at the performance of the business, which has allowed me to continue to invest and grow the portfolio.
I really feel like that's one niche, like the self-employed investor. I really feel it's like one underrated niche going. You don't want us to keep, we're very similar. It's like we don't want to keep trading our time for money, right? That's our business model. It's like, well, then you have to have kind of streams of revenue going, okay, I can have a cash flow through my property, I can have cash flow through my business, but I'm not kind of locked into one asset class as well.
Yeah, definitely. And I think that gives you peace of mind, right? Had I not had the property portfolio, would I have walked away from the mortgage broking loan book, right? I think it gave me options, right? It gave me choice, knowing that I had another revenue stream, another, asset base, another security, right? So I think that's the great thing about property is, it's fairly passive. When I say passive, it's not set and forget because, you have to review your rates, you have to review the rents, but it's set and don't worry, right? You know what I mean? We've all lived in a property. It's not like it can go to zero. We all know what it's about, right? Which makes it a great asset for most Australians to invest in.
Beautiful. Thinking about, again, I'll just dwell on your client interactions. You're talking to a property investor and like, Ross, the rate looks super high. And you're like, mate, the upside is in getting the property, not the loan, for example. So I say that in jest. And I have to you have to have those hard conversations going, I think you've missed the point here. With all due respect, Mr. or Mrs. Client. How did you handle those conversations? I'm very curious because
it's a great point, and it's one that I see a lot of the brokers that I'm working with now also struggle with, right? I think part of the reason they struggle is because many brokers today are transactional. Give me X, Y, and Z, and I'll get you the home or the investment that you want. All right. Rather than looking at it as, okay, Aaron, what's your overall goal? What's your why? What's that end position that you want to get to? And if you define the end position, and it might be, a net asset position, or it might be an income goal, right? So I think if you can make that tangible first, and so you make the intangible, well, I want to be financially free, I want to retire with wealth through property, make the intangible tangible.
Right.
And then once you've got a tangible goal, then it doesn't become about rate or product. It becomes about, how can I work with this person to achieve their goal? All right. So once brokers tap into the bigger why behind what the clients are looking to do, then that's going to take rate out of the question. And then we used to educate clients. And one of the things that I teach my brokers in my programs is around how they can challenge and educate their clients to understand how property works, right? Okay. And as soon as they understand how property works, and somebody like yourself, Aaron, who specializes in property investors, how to get that client that additional property. And as you say, the rate may be, let's call it 1% higher. It's not going to be, but for our purposes, let's say it's 1% higher.
Yep.
Right, so 1%, let's say the property's 600,000. So 1% on 600,000 is $6,000, right? But if you look at the growth of that property, and you look, and even at a conservative level of growth, like the average is probably 6.9 for houses, about 5.9 for units, so probably around 6.4. But if we say 5% growth, right? So that property, if you've a broker that's allowed them to buy an additional asset worth $600,000, that property will grow each and every year by $30,000.
Yeah.
Right? So yes, it's cost them, again, it wouldn't be 1%, but it's cost them 1% extra in interest rate.
Yep.
Cost them $6,000 additional, but every year in growth, they'll make 30.
Yeah.
Right? So again, it's understanding these basics and putting it down in numbers and saying, okay, I get it now, right? If it's going to allow me to reach my goal of, it's going to take me that step closer to the $2 million asset position or $100,000 in passive income, then I understand. I'm on board with that. And then that takes that rate question out of the conversation out of the question.
Yeah, it's a journey that investors need to go on. The broker conversation. We can probably get what's the word, a little bit flippant because we just see numbers and the outcome, whereas the clients probably, and the banks have done a great job, get the lowest rate, and they've conditioned clients to chase the lowest rate. But we're saying if you think it's about rate, you have missed the point when it comes to property investing.
Exactly right.
Beautiful.
Exactly right. It's about the end goal, and it's about, I quite often ask in my programs, when talking about this, when talking about relationship sales and talking about brokers doing annual reviews with their clients. So I ask a question and 99.9% of people put their hand up and say yes. I say, who would like a passive income? Who would like choices in retirement and security and peace of mind? Who would like that?
Sign me up.
Every single one put up their hand, right? Every single person put up their hand. And, I asked them, well, who in your client base do you think would want those things? And everyone wants those things. But it's around how do you ask the right questions to get the right response? And then how do you educate clients to understand that so they can make the right decisions that are right for them?
Yeah. Beautiful. One of the last questions I had for you, mate, was when you look back at your portfolio, right? And I often say, looking back, you can connect the dots because it all makes sense now in hindsight. But you kind of mentioned that you're on the journey of buying, acquiring, and you went through that quite, I would call it aggressive phase where you go through acquisitions. Any, I wouldn't say the word mistakes, but any lessons that came out of that where you go, hey, look, tip for new players, for example, avoid this, or here's what you could do as well?
If I look at it, I mean, if I look at my portfolio, yes, it's like anything, right? If you've got enough of properties, there's going to be things that go wrong. There's going to be enough sort of mistakes, right? So if I look at it, probably I would have probably bought more houses rather than units. I mean, the units performed okay, but the houses have probably outperformed the units, I would say, for sure.
And I feel like that's something that comes sometimes down to affordability, because units were typically cheap. So all of our clients got into the market because they could afford to buy units. So it was the right thing. They got into the market, but houses did outperform, didn't they?
Yeah, definitely, especially with what's happened with COVID and stuff like that. The sort of the land. So probably the houses, I would say, have performed more. I've probably had a few issues where I haven't managed the properties as tightly as what I could in terms of taking more time with doing renovations than what I should have, right? I should have potentially been more on it and more timely in terms of doing some renovations. What else?
Which is a good point. I tell a lot of our investors, like, be a good landlord. Like, don't put up your rents like silly. I mean, I see it sometimes. They're like, oh, we just jack it up. I'm like, yeah, it's great, but you might piss off your tenant, and now you got to like have an empty period as well. So there's an element of, once you're kind of building your portfolio, it's pay it forward and be a good landlord as well. If someone needs something, be there to fix it up. We're going through floods, we're going through issues, for example. People just don't want to live in some type of conditions, and you can understand that it's sometimes the landlord's responsibility as well. And I feel like that's sometimes it's unspoken rule when it comes to investing in property.
Yeah. And I guess looking back, some of the properties that I may not purchase again is just the quality of asset, right? So I went in chasing sort of yield and cash flow, and, the quality of the asset, whilst it's still grown and gone up in value, the quality of the asset has meant there's been more works, more renovations, things that I've had to do with that particular property and caused, more maintenance than had I bought a slightly higher quality product at the time.
Oh, thanks, mate. Yeah. But I really appreciate your openness. It takes a lot of bravery to come out and talk about your journey. I mean, it's quite an intimate detail, right? Like talking about your own property portfolio, talking about your financial position. So a genuine thank you for sharing and being so open as well, man. I know as a broking industry, we truly value what you give, but I feel like this is, again, another iteration of what your ethos is to give back and to help investors grow, scale, and build a successful portfolio, whatever they define that success to be.
Exactly right. And I think that's the key, whatever they define that success to be. And it's different for everyone, and everyone has different sort of aspirations and sort of comfort levels. So what does success mean for the property investor? What does success mean for the brokers? And really defining that is key to people achieving their own goals, that's for sure.
Beautiful, mate. I often say sometimes I feel selfish because I have these conversations and I walk away feeling uplifted, and I walk away going, I've got a lot out of that. And personally, I just want to say thank you very much, Ross. I know I've got a lot out of that. I know when we share it with our clients and a lot of our inquiries that come through, they're going to find it just as valuable, mate. So I want to start by saying, and finish by saying thank you. And I feel like we're going to get you back on at some point again to revisit your portfolio at some point and see how you're tracking as well.
Oh, definitely. As I say, I feel that this is the next iteration for me. I've sort of I had phase one of the property. This is really phase two for me. And I'm really going to look to acquire a couple of properties a year moving forward and adding to what I've done. And, when you see the power of property over time, it makes you really feel that, okay, this is an actual business now, right? This is a business. I'm going to treat it like a business. So, and I think for many of the clients, they should go in with that mentality as well, that, hey, this is a secondary business and it needs that attention because, again, you've got the personal wealth has got to be something different from their own cash flow.
Yeah, wonderful. Mate, words of wisdom. Thank you very much, Ross Lacane. If you want to get in touch, if maybe you're a mortgage broker and you do want to get in touch with Ross, we'll include his details as well. And Ross has been super kind to share all his details. So, mate, thank you very much. That is a wrap on another episode of the Australian Property Investment Podcast. I've been your host, Aaron Christie David. Until next time, take care.